was going to pick up on Caroline, and I completely agree. I think what we're going to see from the S&P is quite a cautious statement, a very cautious message. If you look at the recent statistics that were released by the Statistic Office, we call them SECO in the markets, they clearly said that there were concerns about the export sector. They highlighted 2011 as a potential fragile outlook for the economy, once again mentioning exports. I think the S&P has clearly stated that they are there on the downside in Euro Swiss, and I don't think anything is going to change. They're still going to be talking about intervention, and it's going to be quite cautious overall.
Okay, I just want to move the conversation back to the United States and focus on when the market refocuses on the US and its issues. Rahul writes in and says, I think when you look at the equity markets, we've been forming a very significant head and shoulders in the Dow since 1998. I am targeting sub 5,000 levels on the Dow. And he cites various underlying economic problems that he thinks will support that technical call. America is going to have these problems come home to roost pretty soon, isn't it?
Yes, but with a delayed reaction, and in the meantime, I have to say that the problems in Europe are probably greater than in the United States. And as I said, in the US, what will happen, say the S&P revisits around 900, 950, in other words, we drop another 10% from this level, or say 15%, you can be sure they'll have another stimulus package and another monetary easing with Mr. Bernanke at the Fed. And so economically, I'm not particularly optimistic, but I would say that the economy has probably bottomed out, that we're not below the March-May 2009 level. From there we have recovered somewhat also in terms of industrial production. But in terms of stock markets, I don't think we're going to revisit 666 on the S&P on March 6, 2009.
How can they have another stimulus package at this point, Mark? I mean, what have they got? Near 10%?
Well, they can send each household a check for, I don't know, $10,000, $20,000. They can cut tax.
And that's, I
mean, there are some economies in the US that claim that deficits don't matter, so why have taxation in the first place? You just borrow money.
I disagree. I think up to now Europe has been a bigger basket case than the US, but if we look just beyond the next 6 months and 12 months, Europe is actually trying to do something. The 2020 strategy is good. It's about competitiveness. It's about bringing down labor moves and so on. And I think we actually had a turning point. I think inside the next 3 months, focus will be back on the U.S. You have the federal states budget start July 1st. They will be cutting across the board. If you take California in itself, 60 to 80% of all their expenses are fixed because of the legislation in the U.S. So the federal states is going to be on a massive attack. It will be also politically under the scope because of the midterm election. That's number one. Number two, the slowdown from the U.S. consumers in real-time data is immense. I mean, it is very, very big. It's falling faster in terms of negative growth than it was during the 2008 crisis, number two. And thirdly, clearly Obama wants to just print more money. And the business model of just printing more money is going to run out of time very soon. I don't think there's more room for it. Whereas in the U.S., you have the German model, the Swiss model, where you go for more fiscal restraint. Obviously, it all means, and I think what we have to agree on is that the next 5 years is going to be anemic growth. There's going to be no growth in the world. You're seeing right now, if you look at forward freight rates, they're collapsing. Bulk rates is down 20-30%, 3 to 6 months out. This is not a coincidence, all this happening at the same time. So focus is coming back on the U.S., and that's also why you can be slightly more bullish on you have to be less bullish on the dollar overall, in my opinion.
Less bullish on the dollar, more bullish on Europe. Again.
Well, I'm actually going to puzzle everything together here. If we were going to see equities come under substantial pressure into the coming few months, I think everyone would then refocus on the Fed, and the Fed would do more QE. And if that was going to happen, I think the dollar would come under pressure. And I think that's how you can puzzle everything. Now, whether it happens or not, because it's a bit of a disaster scenario to a certain extent, it's a scenario where equities come under substantial pressure, the Fed forced to step up, and as I said, the dollar comes under pressure. Whether it happens or not, I think we'll be able to judge towards the summer, because liquidity will draw out. It's typical of the month of August, and let's see what happens.
Okay, Mark, I was reading your last note. You were much exercised about the protests and demonstrations going on in Thailand, as you would be, obviously being located there. But I thought what was interesting is how you were trying to draw a comparison with that and also the unrest that we're seeing on the streets of Greece, France around the pensions, other places where the public, quite frankly, are fed up, and the austerity being imposed by governments is the last thing they want to see at this point. By extension, is there any chance that we're going to see these kind of demonstrations in North America at some point if Washington finally cracks down on its budget?
Well, basically we have the tea parties already, and they are peaceful at the present time. But I mean, I travel a lot and I talk to rich people and to poor people. I've never met anyone who is happy with the governments, the way they conduct the business nowadays. The well-to-do people think that the government provides bad services and will tax them too heavily. And the poor people feel that government employees are overpaid and that there is a bureaucracy and that the government doesn't look anymore after the people's interest but after its own interest. So everybody is unhappy, and I think that governments have become like a cancer. They have expanded within the economic system and they absorb far too much out of the economic pie. They should actually all contract massively. That's why I was so much against the Keynesian intervention in the United States and elsewhere. I think the basic problem is too much intervention, too much regulation. You look at America. Which were the two biggest bankruptcies? Fannie Mae and Freddie Mac. Government-sponsored enterprises. Whatever the government touches is usually done worse than if it's done by the private sector. That is a basic principle of the market economy of the capitalistic system.
I think clearly there's a social trend here that people are upset with government. It's much like the 70s, actually. Big government. We have that people got fed up with the banks, and rightly so. And the banks hasn't been playing the PR game particularly well either. And at the same time, governments are just, as Mark says, dirigism is a new word. I mean, the French version of like state intervention at every single level. And they think they got an all-out plan for solving the crisis at hand. And the problem is it's public capital is crowding out private capital, which means the return on the private capital is diminishing. Instead of what we actually need right now is for the market to go for the highest margin return on capital. So like Mark's saying, we're in a world where we have infinite amount of supply of money at zero rate. Everything should have an infinite valuation. And that makes no sense. I mean, you can just start the businesses all over again. And in many markets, credit, despite the credit constraints, like in the mortgage markets, credit is still too available relatively to what it should be in terms of what the income is.
It's all well and good, isn't it, to blow the free market trumpet at this point. But quite frankly, the governments had no option, did they, at the worst moment of the credit crisis? Otherwise, we would have seen more people thrown out of work as corporates reacted disproportionately to the fear of basically losing credit lines at that point.
Yes, I am familiar with this line of argumentation. The Keynesian will all say it would have been much worse had the governments done nothing and we would be in a depression today and so forth. But it's not obvious to me that this is correct. First of all, everybody always, day in, day out, tells me about we have to avoid deflation. Now I'm here in London, I pay something like £470 for a room for one night. The hotel is okay, but I mean, it's not exactly a palace and extremely luxurious. I would be very happy if we had deflation. I would only pay £100 for that room. And so I tell you, when people tell me about deflation, everything I spend, whether it's my first class tickets or business class tickets, my hotel bills, my food, and by the way, in emerging economies, food prices are rising at close to 20% annual rate. So when people tell me about deflation, I think it would be very good for the world to have deflation. Then you and I could go and buy houses at very low prices. We could buy distressed debts at low prices. If the S&P was at 500, I would buy a lot of S&Ps. But at this level, I'm not particularly interested to buy anything.
And
I buy gold in absence of knowing what else to buy. And I'm very interested. I mean, Steve is a smart guy. You have today $1 billion. What would you do with it?
I will take some in gold because of the fiat system, as we both believe in will fall. I will certainly be buying grains long term. I think we are at a turning point, and I will invest massively in that sector. I mean, if I had $1 billion, I'd certainly go buy actual physical land.
Yeah, farmland.
Farmland, yes. Absolutely.
Same. And we can become farmers together.
Yeah. Demographically, we're at a turning point, but basically production can be ramped up in grains. I would look at a basket of dividend yields because you just definitely need equity to pay that, but there'll be global brand names which have access to credit markets, but I think it's essential. And then I will be massively investing in small cap, because small cap is private equity with transparency, and that's where the money is. Because I've invested personally, like in a silly business like headhunting, and that's the return is
we'll just come back to this. No, this is not Hollywood. This is not the red carpet premiere for some movie that you're desperate to get to the cinema to see. This is the press waiting with bated breath for European leaders to arrive, to explain to us how we're going to get out of the sovereign debt crisis in Europe in a one-day summit. 2 days. In a one-day summit, they're going to solve it. Of course they're not, are they?
Of course they will. Just print more money.
Just print more money.
Yes.
That's the solution. And you're just convinced, aren't you, Mark, that the politicians will not be able to help themselves. Print, baby, print. Let's go.
The ECB will talk hawkishly, but act dovish, like the Fed in the US. And by the way, I want to mention one more point. Now that the US dollar has been strong, it gives another leeway to Mr. Bernanke to ease again, because the last thing the US really wants is to have a strong dollar. They want a weak dollar, and the Europeans basically, they're quite happy with the exchange rate where it is at the present time. Not the Swiss, but the Europeans are quite happy where it is, because when the euro went to 151 against the US dollar last November, Europe became relatively less competitive. So everybody in the world wants a weak currency, basically. And what does it lead to is that the strong currencies like gold and silver eventually will trade higher. Now, can they correct 10-20% easily?
Yeah.
Can happen. Anything is so volatile.
Richard writes in and he says, the majority of people I suspect are like Marc Faber. He's not polite to you, Mark. He says they do not understand how the economy really works. If private sector companies and individuals are unable or unwilling to take on more fictional credit money being offered, then no matter what central banks do, they are doomed to failure. The so-called pushing on a string here, Mark, even if they print, we will not spend it.
Well, that depends. I mean, let's say if I send you a check of $1 million, it is likely that you will spend a little bit of that. You understand? You're not going to save it all. Or if you save it all, then you repay debts, and then you move into a better position to spend at a later stage. But I don't believe that the Japanese model 1989 to today is representative. First of all, they didn't print enough money. They could have printed more, but at the cost that the yen would have been weak, and at the cost of a lot of other unintended consequences. And by the way, people who tell me about the great deflation in Japan, why don't they go once and stay in Tokyo? It's still one of the most expensive cities in the world. A taxi from the airport to the city is $250.
Pleasure.
That's the great deflation in
Mark,
Japan.
We've got to let you go, but thanks so much for being with us this last hour. Steen stays with us.